And in our today's session, we wish to discuss about the foreign exchange reserves, where if you remember, one of the advantages associated with international trade is, of course, the exchange in relation to the currencies, such a way a country earns the foreign exchange. When we talk about country earning a foreign exchange, we mean we're able to get the currencies of other nations in our country. So our question is, who is given the rights in the country to hold the currency? Looking at our government, it works so closely with what we call the central bank. In our money and banking topic, we are going to see the role by the central bank. And the central bank has got a lot of authority when it comes to the performance of the banking system in the country. We normally say it does control the other commercial banks. And one of the ways in which it does control the other commercial banks is actually to give the directions on how much should be the charge. For example, $1 should be trading for how much in terms of the Kenya shillings. So that exchange rates are normally issued by the central bank. Also, in relation to how many of the dollars, I'm using an example of the dollars because many can be able to have that taken as a currency by another nation. So if we are to talk about the dollars available in the country like Kenya, and then we have the directives given by the central bank that if it reaches to a level of, let's say, $100, then don't issue anymore, don't sell the dollars anymore. In such a situation, we are talking about the central bank in our country in line with reserving whatever retro is there as the currencies by other nations needs to be maintained in the country. Of course, there are many reasons behind having the reserves built. Like in one day, one time, maybe we are not in good terms with the other nations, and maybe we can't get these currencies. And so we may require, for example, we import the product urgently, such as we require these dollars. So at such a point, maybe we are at war with another nation, maybe for defense mechanism, we need to import much of the defense items like the guns. So if it is urgently needed in the country and we don't have the currency to use for importation, then we might be in a problem. So as a result of that, we may find some holding. Holding means we are not issuing these dollars, yeah? Say at a certain level, we find that we want to maintain a given level into which we will not actually consider to issue those currencies to other people in the country. So in such a situation, we would want to look at exactly maybe how we determine the exchange rate, as well as how we also come up with the directives maybe to have the reserves built in our country. How we get the currencies by other nations into our country is, of course, through various ways. For example, through our exports. We said not always that we produce and we consume everything within the nation. So we may find there's a balance. So where do we take that balance? There could be some other nations in need of whatever we have produced in our country. And as such surpluses, when we export them, of course, there'll be the currency of another nation getting into our country. They are what we call the inflows, yeah? We also said exports are part of the injections into a nation. They exert what we call an expansionary pressure onto the national income of the country. They make the income of the country to increase. So these currencies are coming in the name of whatever we are exporting in the country. And as we do so, then we're able to build our reserves. In other words, our capacity in terms of the currencies by other nation is actually going to be high in the country. Okay. Another way into which we end up having the currencies by other nations in our country is through the foreign investment. Maybe we have a foreigner who has come to our country to do some business. Let's say a hotel established somewhere by an investor who is a foreigner. That way, we might have had the currencies of the other nation getting into our country. Another source of the foreign currencies into a country is when we borrow. When we borrow, let's say from the World Bank, we may get to have the currencies by other nations getting into our country. Sometimes we may be getting some support, yeah, the grants and the aids. We may be supported by another country, and as such, maybe the support is coming in the form of the currencies by other nations, whichever are now supporting us in our country. So those are the three main ways into which a country may end up having the currencies of another nation. I repeat, by exporting, of course, selling whatever our surpluses. We have the foreigners who are buying our products. We may be having the inflow in terms of the currency by another nation getting into our country. Another way we have said is through the grants, through the aids, and sometimes we borrow money from other nations, such as we have the currencies of those other nations, or even from the World Bank. Now we end up having the currencies of other nations getting into a country. And we have also talked about the economic activities, an increase in the level of investments in the country, say by the investors who are coming from other nations, the foreigners. This may also bring about currencies of other nations being in existence in our country. What is the role of the foreign exchange reserves in the country? As I was saying, had asked, is there a need for us to build currencies of other nations in our country? Yes, it is very important. And the role of this is that it will assist us during the times of importing. Not always we produce that which is enough for our own people. Sometimes we require to import, and as we do so, we require to exchange our currency, of course, to have the currencies of the nations where we wish to consider that kind of an importation. And as we do so, then we'll be able to have the people of our country importing the goods and services that are not available in our country. And the support of the industries which are currently established in our country, much of it is by the imports. For example, look at the industrial products, yeah? As we import the machinery, motor vehicles, they are our capital goods required in our local production. So a lot of support is likely to be seen when we allow importation, of course, if at all, we had already built the currencies of another nation into our country. Also, if you are to think about the strength of a currency at a certain point as it trades with the currency of our country, the fewer the dollars will be there in our country, the more expensive it will be for people to import, because such a currency will be trading at a very high rate. So to avoid a situation where we are going to have a high rate of depreciation by our currency, in other words, to avoid a situation where the currency of the Kenya shillings, let's say, is deteriorating in terms of its value, in terms of its strength, as we measure it against the dollars, then it means we need to build a lot of dollars in our own country, because the scarcity of it would mean the expensiveness of it now when people are buying those particular dollars. And that kind of a depreciation in terms of the strength of the currency in the country may also bring about lack of development, yeah, in that particular society. So it is so important to build such reserves, which will be necessary when people require now to have the importation that can be possible in the country. How do we come up with the exchange rate? Like if you're today, if today you are to evaluate the exchange rate per dollar, that rate that is given, it will be equivalent to how much in Kenya shilling. That is what we call the exchange rate. Yeah, it is how much per dollar, let's say in Kenya. And as we do so, we would want to say that the Kenya shillings is maybe weaker or it is stronger in the country. Okay. So the level into which we trade is actually going to be of big importance to our country, so that we find out how is the strength of that particular currency and does it determine the level of importation in the country, which is now going to be a support, for example, to other productions that could be heavily relying upon the imports in the country. As long as we talk about production, which is requiring motor vehicles or the other machinery items, these ones have to be important because it's not happening in our country. So the level into which we import in the country is determining the level of production in our own country. So our exchange rate determination is very, very important. Like today we find the $1. You can imagine $1 trading at $1 is trading at Kenya shillings 109.50. That is our today's exchange rate in the world market. So you find that the strength of the Kenya shilling here, it's very weak. If today we were to wake up and find the Kenya shilling is trading at per dollar, let's say 20 shillings, then that is the strength of the currency that you're talking. And that's why we were saying, if we have got scarcity of the dollars, then you can imagine what will happen to this particular rate. It's going to shoot. And that becomes difficult for people who want to do business, which, for example, are to rely upon the importation in the country. I repeat, if today we were to have the exchange rate, for example, somebody is saying that you can't hear me. Is that true? One of you can confirm. Can
We
you
can
hear
hear
me?
you.
Am I clear?
Yes.
I don't know who is this. Somebody is communicating that can't hear me. Mhm. It's Brano. He has not joined in with audio. There's a message I've communicated on the chat that everybody to make sure that you're on audio, but now somebody who can't hear us, I don't know what will happen. Let's hope that you'll see the chart. So we are saying if per dollar we are paying 109 shillings. This is the situation as we speak today. This is very expensive for somebody who is doing business and he is located in Kenya. If such business is heavily relying upon the importation, yeah. So if today we were to have the Kenyan currency trading per dollar, we are paying 20 shillings, that becomes affordable now for people to import and of course to do business involving importation in the country. And again, if you are to go by what we were discussing earlier here, when we now miss this chance to have the building of the currencies by other nations in our own country, it would mean the shortage. And when something is not in plenty, we all know price goes up. So we don't want to have the currency of the Kenya shilling deteriorating in terms of its value because of lack of the dollars in our country. That's why the reserves building here was very important for it to be considered in the country. Um, why do we require the foreign currencies? The same argument we had earlier on is for us to be able to do business. We want to transact, we want to trade with other nations, and it's not possible for us to trade with our Kenyan currency when we are talking of now importing commodities from another nation. It will not be possible, and that's why we should build the currencies by other nations in our own country. Okay, let's now look at the various types of the foreign exchange rate determination. And we'll start by looking at the most common way of determining the exchange rate, which is a foreign exchange kind of a determination method known as the floating exchange rate system. This is where the way we normally say, when we go into the market, the price of a commodity, if the market is having some competition, is going to be rate free. It's going to be controlled by the forces of demand and supply. It's the same language we are going by when it comes to how many people are demanding for the dollars, how much of the dollars is available in our country. Such a way, when there's a shortage of the dollars, then it means the exchange rate will be high. And if it is in plenty, then it means the exchange rate will be low. In other words, the currency of the country is going to be stronger given that there is the supply of the currencies by the other nations in that country. Otherwise, the shortage of the currencies by other nations in our country definitely to make our currency to be weak and the rate of exchange will be high in the country. So the demand and supply forces, when they interact, they may determine the exchange rate in a particular country. Of course, sometimes the country's, let's say, performance, like we were saying earlier, the sources of the currencies of other nations into our country may be determined by, one, the exportation, number two, the borrowing and the gifts that we get in terms of the aids and the grants in our country, and number three is out of the investment by the foreigners in our country. So you can imagine the levels of such may be affected also. Like we are talking of, what do we export in the country like Kenya? We export mostly agricultural products, which are heavily affected by the weather conditions, like the today's situation. So if the weather condition is going to be an effect on to our lines of production, then it means we'll be exporting very little, or there is nothing to export, meaning no dollars in our country. And if that is the case, then where we were expecting the currencies of other nations to increase in our country through exportation, then there'll be a shortage. And definitely out of a shortage, the exchange rate will actually go up. You see, the effect of now the exchange rate or rather the exportation in the country, bringing about a change in the exchange rate. On the other hand, if our lines of production are supported by, like, let's say agriculture, we have got good weather condition, our output in terms of agricultural products will be high, export levels will be high, and more we export, the more we are likely to get the currencies by other nations in our country. So in such a scenario, the foreign currency will actually be high in our nation, and that means the exchange rate is going to be somehow low. Again, we are talking of about something like a loan that we have taken from another nation, and we have debts all over. Let's talk about Kenya as a society. In terms of the infrastructural development by the government, we end up having a lot that we have borrowed. So we may borrow, but the payments that we are making now are also huge, yeah, in terms of the interest, in terms of the principal amount out of the borrowed amount. So you find the way we are having an outflow in the country is high. So as much as we talk of, yes, we can get these currencies through borrowing, then the rate of return is also high. So you find there'll be a shortage of the currencies by other nations in our country. So the exchange rate is likely to be high. We are talking of the Henry remain on mute. We are also talking about the foreign investment in our country. This is the African region, where in many situations you find we are not having a conducive environment for foreigners to come and do business. Political instability is so high within the African region, and people shun away from doing business in our country just because of the chaos that are witnessed to happen within this particular continent. So at the end of the day, as much as we are saying, yes, currencies can come through these three ways, we will find that they are very retro that are now coming into the nation. And in many scenarios, you find these nations that we are talking of will have shortages of the currencies by other nations. And by so doing, you'll find that there is a high exchange rate. In other words, the currencies by the developing nations are always going to be retained low when it comes to the world market. That is, they are weak kind of a currency, which is trading with some strong currencies like the dollars in the world market. What are some of the advantages and the disadvantages that we can accrue to when it comes to the exchange rate determined by the forces of demand and supply? Number one, as an advantage, we are able to have a free kind of a situation of the determination of the exchange rate. There's no need for the government's interference. There's no pressure for the government to come into play and decides on the rates to which we are going to trade with the currencies of other nations in the world, such as we just let it to be free, controlled by the free forces of demand and supply, that there'll be no cases where we're going to blame the government in reference to the determination. This is no longer price control. We have decontrolled everything where everything is under the forces of demand and supply. Another benefit is that you realize that the method itself is speaking so much about high exchange rate, for example, coming as a result of the scarcity. So we would want to find ways into which we can, let's say, increase on the levels of the exportation. In other words, we want to address that shortage. We want to address that scarcity. Where is it coming from? Is it as a result of our exportation levels being low in the country? If so, what can we do to support our declining industries? How can we support, let's say, agriculture? If that is the main source we over rely upon when it comes to the exportation, what can we do? If we wish to diversify, then which other lines of productions can we propose and how can we support them so that in return, then we end up having heavy levels of exportation and we'll also be able to increase the currencies of other nations into our country. What can we do, in other words, to phase out that particular scarcity of the currencies of other nations in our country, okay? If it's about, let's say, this political instability that was bringing about low levels of investment by the foreigners in our country, what can we do so that we cultivate an environment that is conducive, that is attractive for people to come and do business in our country? What do we really require to do? How can we address such a challenge so that we increase the level of the currencies by other nations into our country? Another advantage of this particular method is that itself is a way of refining our balance of a payment that was maybe at a deficit, because as we try and address the issues of the scarcity, look at what we are doing. We are trying to avoid heavy borrowings. We are trying to avoid political instability cases which are deterring foreign investment in the country. We are also trying to support our industry so that our export levels can also increase. And as we do all this, look at this, it is possible to have a correction that we might have had on what we call a disequilibrium balance of a payment. Maybe we also think about the devaluation policy. Devaluation policy is a situation where we are weakening our currency of the nation in a way of attracting the foreigners to come and buy our exports. But as we do so, we end up having a problem of now making our currency to depreciate in terms of its value. So if that is the situation we have gone by as a measure towards deficit balance of payment, we may wish to rectify that in our own country. Okay. A few of the disadvantages associated with this method. Of course, we are not sure of what is going to happen tomorrow. From one day to another, there is a scarcity, there is a plenty form of the currencies by other nations in our country. And as the rule states, the forces of demand and supply are dominating. For sure, I don't think there's a point where we'll stay at an equilibrium point where demand for these currencies, the supply of these currencies are going to be at par. In a rare case, that would happen. So many other times when we'll have what we call disequilibriums, disequilibrium between demand for the currencies and the supply of those foreign currencies. And when a disequilibrium occurs, then it means fluctuations. Yeah, we can't say that as we speak today, the same rate will be trading tomorrow. Maybe it is going to go up, maybe it's going to go down. So those uncertainties may loosen somebody when it comes to a decision to make in the business. Like you're fearing of with the curfew, for example, today and the lockdown, maybe the exchange rate will be higher than today. So you can't plan on how to perform in your business as a business person. That kind of a plan that you do look forward into achieving for your own business may not be properly executed. And when things are not planned for, then you find that there's a likelihood of a failure in return. A successful project comes with good planning. So when people cannot plan or they can't have a direction to do the planning because of the fear, because of the uncertainties brought in by these fluctuations on the rates of the exchange, when all this is happening, you'll find that very few are likely to persevere and get into the business. And lack of trading activities in the country definitely means lack of growth, and that itself may also signify lack of development in the same society. Again, we with the fear and of course the speculations going on in the country that in this month usually the exchange rate is high, this other month it's friendly, uh, that itself may worsen the performance of the country, because you find some months no one wants to do business or no one wants to consider a form of investment because of a huge loss that is likely to be coming out of the business. And such definitions themselves may actually worsen the performance in a particular country. And of course, the lack of discipline in terms of this is the not the normal discipline we talk about for somebody, but we are talking about the way the exchange rate itself is behaving may bring so much implications into a country, such as inflation. And when we experience inflation, which is a period of time, class, when prices of the goods and services in general are increasing, definitely that threatens so many other things in our own society. Of course, inflation, as we later on see in the discussion about inflation, is not always harmful. Inflation can be helpful, especially when it is a creeping inflation at a rate of 2 to 3%, at a rate of 4 to 9%, again, moderate kind of an inflation. Those ones are very good to happen in our country because they do attract investment. Remember, as a business person, you consider to do business where you find a return, of course, attracted by the price of the commodity in the market. That good prices makes people to venture. And of course, when there's high level of investment, that itself may also mean we are able to get job opportunities, consumption is high, so support of the industry is already established. It's a cycle. We're able to eliminate what we call the vicious cycle of poverty. So with that lack of discipline on how this exchange rate is behaving, today it's high, late is low tomorrow, we may not be able to predict what is going to happen. And as we experience the high and the falls on the high rises and the falls on the prices of the goods and services, of course, people may lose the trust. And when we lose trust, especially where business is involved, of course, that is a danger which may threaten the growth and development of the country. Another type of the exchange rate is what we call the fixed exchange rate. This is a rare case, of course, to happen in most of the economies. I don't know whether we can agree that for all the years we'll be trading with you, this is a country, Kenya, with another, talking about the exchange rate and, of course, determining this to be permanent over a given period of time. Many of the countries may not agree on to this because to some extent, one of the nations is likely to suffer, like your currency is gaining value, it's appreciating, the other one is depreciating, then you find that the currency of one nation may actually make the other to suffer when it cannot adjust due to the fixed amount already set as the countries trade with each other. It doesn't go well for somebody to say this is going to be the case for all the days that the price per unit of my product is going to be 20. You'd want to have that flexibility, which we saw coming in the floating exchange rate system. So this is a situation where the government itself may be the one to determine through the central bank, may come up with just one figure, of course, to determine the exchange rate. Its benefit is one, that it may make things to be somehow stable in terms of planning. Like if it's a business person who is buying, let's say, a product A important, all the days as he does his plans on how to go and import, how to come and sell the product, that may be stabilized in the economy. There's a way into which you are able to reduce the uncertainty issues. The fear is no longer there. You are stable in your business. And again, fixing the rate, let's say we say 80 shillings per $1. Then it means all the commodities which are being imported at such a rate, their prices are likely also to be affordable by most people in the country, or they are going to be stable, meaning fluctuations in the prices of the goods and services, of course, depending on the importation in the country, are likely to be stable, which means we can avoid situations of inflation in the country. So that can actually act as a solution if the government were to agree with another government that this is the exchange rate that is going to remain fixed, then by so doing, we are able to stabilize our prices for the various goods and services, and we avoid inflation in the country, meaning earlier on I'd said inflation is not always harmful. Sometimes it is helpful, but not always that now again it is helpful. If the rate of inflation is beyond 10%, then that becomes harmful to a society because majority won't be able to afford the commodity. And when that happens, then a way forward into fighting inflation is required. And one of it is to have a fixed exchange rate of the currency of the country, of course, with another currency of a different society. Some of the disadvantages associated with this system would include number one is that the country will be required to maintain a huge exchange, the currencies of other nations should be a lot in our country. If you're talking about stabilizing the exchange between the dollar and our Kenya shilling, then there should be a lot of dollars in our own country. Because the moment there'll be a shortage, we can't use this method anymore. We go back to the floating exchange rate system. So the building of the currencies in our nation should always be at a very high level, which is not possible, especially in the less developed nations. We go back, where do we get the currencies from by other nations? We get them from such sources like exportation, such sources like the foreign investment, and another one we have talked about, the loans, the aids, and the grants. You see, these items themselves are not going to be stable. They'll be affected in one way or another. Maybe our export level are very low. So where do we get these currencies to build up so that our exchange rate is going to be stable? It may be a big problem in most of the less developed nations. Another very important thing is, you see now, we have our currency, and maybe there's some interest rates attached to the way, for example, we are trading in the country. We may have a way of defending our currency by raising the interest rate. For example, if you're to talk about, let's say we have lent to another nation, as we get the returns, we say the interest rate is going to be high. But now, as the price of a product increases, its demand goes down under normal case. So if it is above the interest rates, then it means the demand for the loanable funds will go down. And that could also be threatening investment in other nations or even within the local area. Another very important disadvantage to argue in this particular exchange rate is that it could actually be a way into which we overestimate our value when it comes to trading with other nations. So we want say we have an exchange rate that is constant, so that we are seeing as a nation that is stable, which is more or less like a lie, because depending on the, of course, the performance by the nation, that is how the strength of the currency should be seen in the eyes of other nations where we could be wishing to use the currency of the nation, yeah? And finally, is a situation where you see the way we were we were having our exchange rate fluctuating. We saw there was some uncertainty. This one is stable. There are no such flexibilities around. But on the other hand, we may not we may not have a good way or a good case to argue in reference to how, for example, the fixed system is going to give a direction to somebody who wants to do business. Because sometimes you hear of there speculations around maybe in regards to an area which is a good area, let's say for investment to consider in the country. And when speculations are going on in the country, people may feel they can gain a lot. People may feel they are likely to lose. Yeah, as such cases where you are now having a stable rate or a rate that is actually fixed, it doesn't actually give you the chance to exploit those ideas. Yeah, it doesn't give you a chance to now see on this other end what could be the benefit if I were to change my investment from A to B. What are the benefits if the exchange rate is going to remain maybe constant? So if we allow fluctuations, of course, it's also allow a chance for a change to be incorporated in the minds of the business people. So we would say that the exchange rate, number one, the floating exchange rate system and the fixed exchange rate system, that is one that is better than the other. Of course, it will depend on what the nation wants to achieve, what are the goals, what are the aspirations by the business itself, by the nation itself, sorry, not the business. Factors that do determine the exchange rate. We saw the factors that were determining the level of the currencies by other nations in the country. Let's now evaluate the factors determining the exchange rate. Number one is what we call the balance of payment. Many other times, we have sung of this many times now, the balance of payment for a less developed nation is likely to be at a deficit, which means that if we were to reduce the currency of the country, maybe because we are in a pressure of trying to bring a balance of payment at an equilibrium point, maybe through exportation, let's say we devalue the currency of our nation. So today we are saying $1, 1 US dollar is equivalent to 109.50 Kenya shillings. So if we devalue, let's say tomorrow we hear of the government changing this to like shillings 200 to be trading per dollar. That is what we can call devaluation policy. And why the government may wish to devalue is to increase the level of exportation in the country and reduce the level of importation so that we may try and bring a deficit balance of payment to an equilibrium. So we may now come up with a rate because of what we want to achieve, driven by what we are calling the state of the country's balance of payment. Number two is what we call the relative level of interest rate. The higher the interest rate, the more the better the rate into which the currency will be trading. In other words, the interest rates tend to like push the strength of the currency to be higher. This is what we call an expansionary pressure set by the interest rates that are high onto the currency of a particular nation. Just like the price of a commodity, of course, making somebody to react on this other end. If you buy a product at a high price and maybe you want to sell it to get something, then the price to which you'll sell will be at an even higher price. The level of inflation. Inflation is what we call the increases in the prices of the goods and services in general in the country, which makes the depreciation of the currency of the country to be seen, such as there is a high price of the product in the country, and when it comes to now people wishing to do business in that nation, you'll find that there are very few people who want to buy our product. So prices, as a result of the inflation level being high, would actually make the currency of the country to be weaker. It brings about the depreciation of the currency, and therefore the exchange rate to be determined there would be a lot of the Kenya shillings will be assigned to just $1 at the end of the time. Speculations. Many other times, like now with the lockdown, people are speculating that the dollar would be very expensive. I can't tell because the experience just for a few days by now. But now again, we are talking of a situation where the currency of the society is determined by what people are to believe and they hope to see happening in the country. Of course, based on the circumstances that our people are going through, one may be able to predict or to just have a way of speculating on whether the currency of the nation is going to be weak or maybe to be strong in the world market. Government's policy. I go back to the first the first statement about the balance of payment being at a deficit. One of the ways into which we may wish to solve such a problem is through the devaluation policy. So, a devaluation policy to December is a government's deliberate move taken to devalue or to lower the currency of the country. And when that happens, when the government says maybe 200 shillings per dollar, that would itself mean another exchange rate has already been identified through the government's policy or through what the government wants to see happening in the country. Finally, the political atmosphere. I don't know about the African region because this is a problem that we have been experiencing so many times, that when we are not in good terms with other nations or when in our own country we have fights going on, it is so hard for people to be attracted to trade with us. And when that happens, then as a result of the shortage of the foreign currencies in our country, the exchange rate tends to be very high in such a society. However, you need to argue on the other side because if the atmosphere to do business or to trade with other countries is good, then it may make our currency to be strong and therefore the exchange rate to be relatively low. So that is all that I can talk about in reference to international trade. And I would wish to give one small exercise class. We discuss about the economic unions, and the implications to the growth and development of the society. We have four of them. One of it is a free trade area. How does it operate within the member countries? The FTA. We also have the custom union, for example. How does it work in a society? The sorry, this should be economic integration. Sorry, the economic integrations. Sorry for that. The free trade area, the custom union, the economic union, which is at a higher level. I want you to discuss about those four forms of integration where countries may be coming together. They agree on the terms and conditions when they are trading. If it's about the rates that we were talking of, can we agree maybe to fix it at a certain level? Or can we agree to abolish, let's say, tariffs that we were talking of within the member countries, and maybe non-member countries, we apply a certain rate? All these are forms of integrations that a nation may come with another country, and when they are trading, of course, there are some benefits and there are some problems that the nations are likely to be going through as through these particular forms of integrations. Now, when you look at the forms of integration, as I was saying, there are some benefits, there are some problems. I want you to look at now the implications of these integrations when it comes to the performance of a nation. How does the economic integrations, look at this, implicates onto the growth and development of the country? What are the implications of the economic integrations towards the growth and development of a particular country? I suppose you can look at that during our free time.